Alright guys, I hope you're still with me in this. The next topic that we're going to take a look at is what are trading styles. Now, you must be curious as to what the hell I'm talking about when I mention trading styles, right? So let's take a look at it. The first style of trading is intraday trading. Now this has gained a lot of popularity because of people boasting about making 20, 30, 50, 1 lakh rupees in a day, and that is has brought a lot of people into the concept of intraday trading. But let me tell you, intraday trading is one of the riskiest forms of trading in the stock market, and let's take a look at why. So what is intraday trading, right? It involves buying and selling of securities on the same day. None of the positions that are taken today are going to be held till tomorrow, right? The market opens at 9:15 and closes at 3:30. So all the trading activities that an intraday trader will conduct will have to be within the scope of those hours on a daily basis. If you hold a trade overnight, that's no longer intraday trading. So if you look at Zerodha, which is the broker of my choice, you have the option of MIS, which is margin intraday, and you have the option of NRML, which is holding it overnight. So those are the options that you get. And the difference is that if you choose margin intraday, your orders are your trades are exited at the end of the day somewhere between 3:20 and 3:25. So the broker does it for you. So it is just to tell, when you select what type of order this is, you're just simply telling the broker that I no longer want to hold the position overnight, and make sure that if I don't do it, you should at least exit the trade for me at the end of the day. And the broker will make sure that all MIS, which is margin intraday orders, are exited before 3:30, which is when the market closes. You may enter the trade at any time during the day, but you will make sure that the trade is exited before the market closes. So the benefits of intraday trading are that if you are someone who enjoys quick decision making, who's good on their feet, it is something that you can consider doing, because it requires very, very quick decision making. You have to be very precise at entering at the right price and executing your trade at the right opportunity. Because in intraday, if you miss the trade, it is hard to get another. But when it comes to, say, swing trading or positional trading, you have some more leeway because your position sizes are slightly smaller and you're also looking at a longer horizon. And I will get to what those other two types of trading that I mentioned are in just a second. Intraday trading also requires a great amount of focus and very, very tight risk management. Now, about until a year ago, SEBI, which is the Securities and Exchange Board of India, came out with a circular that mentioned that all brokers are no longer allowed to provide intraday margin. But before that, the situation was that all these discount brokerages would provide heavy intraday margins, which would mean that on a capital base of 1 lakh, you could trade on an intraday trade for values of up to 10 lakhs. So that means you got 10x margin. Now that meant that skilled traders could take advantage of that and make insanely high profits, right? Of what they could with their original capital. If on 1 lakh you're making, say, 2,000 rupees a day, times 10, now you're making 20,000 rupees a day. But that also means that if you're losing 2,000 rupees a day, you're now going to lose 20,000 rupees a day with 10x margin. So that is why I believe SEBI came to a conclusion that such heavy margins are going to kill these brokers and kill the market participant, as a lot of people are going bankrupt because of that. So that's when they decided to kill the intraday margin concept that was existing. So that's what I mean by tight risk management, because if you're using leverage to enter any trade, you have to make sure that the risk that you're taking on that trade is tightly managed and you're not losing a crazy amount of money. The next style of trading is positional trading. Now, I happen to be a derivatives trader who's a positional trader, right? I don't necessarily always trade intraday, but I prefer positional trading. Now, positional trading is when trades are held overnight. Now, you may hold it as a BTST trade, which is buy today, sell tomorrow, right? So that is also considered a positional trade, or you may hold it for the duration of 1 week or less, right? 1 week or less is what I consider as positional trading. Now, the reason for that is I happen to be an options trader, and every Thursday of the week is the weekly expiry for options. So I trade from one expiry to the next. So that is why I'm considering a 1 week to be the horizon of a positional trade. So positional trades generally take slightly more time to play out compared to intraday trades, where in the same day you're expecting a momentum to occur. But positional trades can take 2 to 3 days for it to come to fruition and for you to reap the benefits of your hard work in analyzing the market, right? So that's why it takes some more time to play out. But in that event as well, the situation is that it involves overnight risk. Now, overnight risk generally is something that people completely discount. They forget that such a thing exists, but it does exist, and it is like a black swan event, right? So, a black swan event is something that occurs outside the scope of the market, outside market hours, where you simply cannot do anything about it, right? Market is only open for 6 hours a day, guys. So 18 hours a day is way too much time for anything to occur across the world. While the Indian market is closed at night, the US market is open, the Europe market opens in the evening. So anything can happen. A war can get declared, a pandemic can get declared, a natural disaster might occur, and that will cause the markets to open 10% lower, right? The way it did during the COVID crash that we all remember from 2 years ago. So such an event happening is always a risk that exists and you can't discount it. So a positional trader is always holding on to the overnight risk of the market opening much lower, right? So when it comes to positional trading, the position sizing is always different to intraday. In intraday, you can actually you even if the market goes against you significantly, you still have the option of placing your order. You have the option to make changes to your position, to your portfolio. But when you leave it overnight, you don't have that option. So that is why the position sizing is much lower in positional trading compared to intraday. That is because even if the market opens lower, but your position size is small, instead of 1,000 shares, you're only holding 100 shares, you're not going to lose as much money and you're unlikely to go bankrupt in a day by holding on to lesser number of shares. The next style of trading is swing trading. Now, swing trading is also something that I enjoy doing for stocks, and these are trades which are generally held for 2 to 4 weeks. And these are extremely common among equity traders who are trading a range-bound stock. Right? For a lot of stocks, they enter a range which they're not able to break out from. So swing traders, what they do is when the stock comes into some selling pressure and finds a bottom, they buy it at the bottom, and once it goes back all the way towards the other end of the range, they sell it at that price, and they keep trading the range as a range bound market is providing it. So that is where you're trading each swing of the market. You buy it at the low of the swing and you sell it at the high of the swing. So hence it's called swing trading, right? It's common among equity traders during earnings season as well, because let's say that you're expecting ICICI Bank to deliver extremely phenomenal results in this quarter. So a couple of weeks before ICICI Bank comes out with results, you're getting the stock at a good price, so you buy it. And your idea is once the results are out and once the information is seen in the market where the stock price has shown a significant rally, I will exit that trade within a couple of weeks. So that is one form of swing trading. And a lot of people like to trade events as well. Let's say that you get an idea that company X is going to invest a lot of money in company Y, and that is likely to benefit company Y. So you pick up the shares of company Y in the anticipation that the stock price will rally. So you're trading an event that is likely to occur, and that takes a little bit of time to happen. So you hold the trade for 2 to 3 weeks, and that is one type of swing trading as well. This is also very common among beginners who are trying to practice this skill in the market, because intraday trading is quite risky and involves a lot of capital. You practice it by buying a small quantity of shares, holding it for a few days, and just trying to acquire the skills to become better at analyzing the market. The final style of trading is algo trading. Now, algo trading was earlier very commonly used by institutional traders who had very large amounts of capital that they had to execute using computerized algorithms, and they could not do it manually. So that is how algo trading became a part of the stock market. And later on, it was used to analyze a large amount of data to gather information about price momentums, and it is used for intra-second trades, intra-minute trades, etc. nowadays. But it has also started gaining some steam among retail traders as well in recent times. So there's an article that I read on Economic Times recently that mentioned that currently among the traders that exist in the Indian stock market, only 15% are involved in algo trading, but about a year ago, it was only about 7%. So it has almost doubled over the course of 1 to 2 years. So that's quite significant, and it is definitely gaining a lot of attraction at this time. Now, the way algo trading works is that there is a predefined structure and predefined conditions that are set by the trader. And once these conditions are satisfied, the trades are automatically executed for you. Let's say that you set the condition that once the price reaches 1000 rupees, I want to enter and set the stop loss at 900 and a target at 1200. Okay. So as soon as the stock price touches 1000 rupees, the algorithm will execute the trade for you and buy into the stock at 1000 rupees. And let's say that the stock starts moving down towards 900 rupees, the stock will then exit the trade. The algorithm for you will exit the trade at 900 rupees without you having to press any further buttons. Algo trading not only requires a lot of knowledge in finance, but it requires a lot of coding knowledge as well, because you're actually writing the code in a particular language and using an API provided by a broker to execute these trades for you.